Hey there, let's dive into a company that's become known for its journey through incredible highs and dramatic lows, Carvana. They disrupted the traditional car dealership model with a fresh, online-based, and some may say peculiar approach to car buying. It's a tricky business to profit in to begin with, but as quickly as Carvana defied the odds and rose to success, they also faced some major obstacles in swift fashion as well. It seemed at one point the company could outright fail. In a twist of fate, Carvana managed a tremendous comeback, proving it's a player to watch in the automotive space. Let's break down the condensed version of the rise, fall, and rise again of Carvana. Carvana was founded in 2012 by Ernie Garcia III, who had a vision of transforming the car buying process into a fully online experience. His vision was for customers to skip potentially awkward dealer negotiations, the endless paperwork, and for people to be able to simply buy a car as easily as adding it to their cart online. That was Carvana's pitch: convenience, transparency, and efficiency. Carvana's early success was driven by the rise of e-commerce and consumer demand for an easy online shopping experience. As people got more comfortable buying big-ticket items online back in the early 2010s, Carvana attempted to capitalize on this shift, making it possible to buy a car from the comfort of your couch. By offering a 7-day return policy, comprehensive inspections, and a wide selection of vehicles, Carvana quickly gained traction. It sounded so ridiculous and that it shouldn't have worked, but it was. And not only did Carvana's business model work, it began to work fast. By 2017, only 5 years after its inception, Carvana had gone public and its stock soared. With each year, the company was doubling down on expansion, reaching more cities and states across the US. It wasn't just a used car seller, it was a scalable tech company that used data and logistics to move inventory and fulfill orders nationwide. From 2017 to 2020, Carvana's growth was explosive. Revenue soared from just $1 billion in 2018 to almost $6 billion in 2020. During the pandemic, with traditional dealerships struggling, Carvana saw an even bigger boost as people turned to online solutions. Consumers could buy a car without stepping foot outside, and Carvana's business surged, and the stock continued to explode. However, behind the scenes, cracks were starting to show. To fuel its rapid expansion, Carvana was borrowing heavily and burning cash. Logistics for used cars are tricky, and the same thing that was making them successful initially started to go south, like struggling to manage inventory, delivering cars across states, and meeting quality standards that requires major investment in infrastructure. By 2021, Carvana was facing challenges with fulfillment and delivery. Customer complaints started piling up about late deliveries, paperwork errors, and issues with car quality. As these issues mounted, Carvana's stock began showing signs of instability and distribution. Investors were getting nervous about the company's high debt levels, and the initial excitement around Carvana's disruptive model began to wane. But the worst was yet to come. In 2022, the wheels really started to come off, pun intended. Carvana was hit by a perfect storm of challenges. First, unchecked inflation skyrocketed, and the Fed was behind the eight ball and had to aggressively raise interest rates to tame it. This affected the affordability of used cars as financing became more expensive. This in turn reduced demand. The cost of borrowing increased, and Carvana's heavy debt load became even more costly to manage. Simultaneously, the used car market was facing its own issues. The price of used cars, which had surged during the pandemic and into the following years due to supply chain issues with new vehicles, started to stabilize and then drop. Carvana had overpaid for inventory, and with prices coming down, the company was at risk of bag-holding cars it couldn't sell profitably. In addition to financial troubles, operational issues grew worse. Carvana's customer satisfaction ratings plummeted as the company struggled to meet delivery timelines and handle administrative details like transferring vehicle titles. States like Michigan even suspended Carvana's license due to title and registration violations. By mid-2022, Carvana's stock took a nosedive. It had once traded as high as $370 per share in 2021, but by late 2022, it was below $10 per share, accounting for a 97% drop. Most companies do not ever even come remotely close to recovering from this. Investors lost faith in Carvana's ability to turn a profit, and some analysts were openly speculating that the company might go bankrupt. The debt was mounting, customers were frustrated, and the company's innovative vending machines seemed more like a costly and quirky novelty than a real asset. At this point, the industry and media were writing off Carvana as another high-flying tech company that couldn't turn its vision into a sustainable business, a story we've seen many times. It seemed like Carvana's end was near, a cautionary tale about growing too fast without focusing enough on business fundamentals and failing to build a sustainable path to profit. However, just when things looked darkest, Carvana took steps to turn things around. The company realized that it needed to fix its various issues and address its logistics head-on. Carvana's leadership focused on cutting costs and streamlining operations, which included layoffs and reducing its advertising budget. One of the most significant changes was how Carvana began rethinking its inventory strategy. The company had previously been focused on acquiring as many cars as possible to fuel its rapid growth, regardless of prices. Now it became more strategic about inventory management, focusing on high-demand models and cutting down on unprofitable stock. At the same time, Carvana worked on improving its customer service processes, investing in technology to manage deliveries and paperwork more efficiently. The company worked closely with regulators in states where it faced legal challenges, addressing compliance issues to avoid further penalties. Their resurgence was also fueled by strategic partnerships. The company began working with financial partners to manage its debt load, allowing it to refinance some of its obligations and reduce interest costs. This move gave Carvana more breathing room to focus on operational improvements without the constant pressure of looming debt to manage. To enhance its logistics, Carvana also doubled down on its technology investments. It used data analytics to better predict demand and optimize inventory, and it refined its online platform to improve the customer experience. By focusing on what made it unique in the first place, a seamless online car buying experience, Carvana started to regain its footing. And fortunately for them, the car market began to stabilize. As inflation pressures eased, consumers once again started looking for affordable options in the used car market. Carvana was back in a position to capitalize on demand, but this time with a stronger, leaner operation.
We had a lot more comeback in us.
With its newfound stability, Carvana began focusing on a more sustainable growth path. Instead of prioritizing rapid expansion, Carvana's leadership committed to profitability. The company scaled back on opening new locations and focused on enhancing existing operations. Carvana also adapted to changing consumer trends. Recognizing the popularity of eco-friendly vehicles, the company expanded its inventory to hybrid and electric cars, adapting to demand. This helped attract a broader customer base and align Carvana with trends in the automotive industry. All of what they were implementing began to show up in their results, and they were finally posting positive earnings and earnings per share. Today, Carvana is in a much stronger position than it was at the height of its struggles, of course. The company's stock has rebounded from its lowest points and is making a huge run again towards its highs. Investors have regained some confidence, and the road ahead for Carvana is about steady growth rather than the rapid expansion it once pursued that led to the boom and bust. So what can we learn from Carvana's wild ride? First, rapid growth can be a double-edged sword. Expanding too quickly without building a solid foundation can lead to major issues down the road. For Carvana, the push to grow fast led to debt, logistical issues, and a loss of customer trust. But the company's ability to course correct shows that resilience and adaptability are key. They gave themselves a second chance, proving that even companies on the brink can make a comeback. And that's the story of Carvana's rise, fall, and rise again. From a disruptive startup to a bent but not broken company, and now an incredible comeback story, Carvana's journey is one of perseverance, strategic pivots, and learning from mistakes. It's a reminder that the road to success isn't smooth in business, and many times it's a very bumpy one. Thanks for watching. I hope you enjoyed, and share your thoughts on Carvana's story in the comments below.